Imagine, just for a second, a bustling financial metropolis. Millions of people, billions of dollars changing hands.
Right, just pure chaos.
Yeah, exactly.
Yeah.
High-frequency trading algorithms just humming away in the background, executing thousands of orders every single millisecond. It's chaotic, sure, but it's deeply fundamentally structured. I mean, there are rules. There are circuit breakers.
There's a safety net.
Yes. Deep pools of institutional capital acting as this, massive concrete foundation beneath all that noise. But then, imagine a siren rings at exactly 4:00 p.m. on a Friday.
The closing bell.
Right. And those massive institutional skyscrapers literally just lock their doors. The market makers, the banks, the regulators, they all pack up their briefcases, shut down their terminals, and just go home for the weekend.
They're gone, completely offline.
But the streetlights stay on. The trading floors are left wide open, and a completely different crowd just sort of walks in to take over the city.
It's a really profound structural shift. I mean, you transition from this highly regulated, institutionally governed machine to an environment that's driven, well, almost entirely by raw, unfiltered retail psychology.
Just pure emotion.
Exactly. Emotion, highly leveraged speculation, and, decentralized algorithmic bots. The architecture of the market is still standing, but the physics of how prices move within that architecture, it completely changes.
And whether you're a seasoned crypto trader who spends, your Saturday nights staring at candlestick charts in the dark.
We've all been there.
Oh, absolutely. Or maybe you're just incredibly curious about how market mechanics actually function when the institutional suits leave the room, you are in the right place.
Because it's wild.
It really is. Today, we are unlocking the mysteries of weekend Bitcoin trading. What actually happens to the market when traditional Wall Street logs off, but the blockchain just keeps on hunting 24 hours a day, 7 days a week.
It's one of the most fascinating structural anomalies in modern finance, really. Well, in traditional equities or commodities, time essentially just stops on the weekends. You have the Friday close, and then you're in this frozen state until the Monday open.
Right, nothing moves.
Exactly. But in crypto, time never stops. The market is always open, but the liquidity profile completely transforms. And understanding the nuances of that transformation, I mean, that is the difference between finding a legitimate statistical edge and falling into a really, really expensive trap.
And we have a massive stack of sources to help us navigate this phenomenon today. We're pulling hard volatility data from Investopedia.
Great baseline data there.
Yeah, and we've got quantitative momentum strategies straight from Quantpedia, practical trading mechanics from IG Bank and Binance Square.
Plus the behavioral stuff, right?
Yes. We're looking at deep behavioral analysis from the Advances in Consumer Research Journal and pulling advanced risk management protocols from MentorQ. We are putting it all together for you.
It's a lot to cover.
It is. So, okay, let's unpack this. I want to start with the architecture of the weekend ecosystem itself.
The foundation.
Right. Because according to the data from MentorQ and Binance Square, the very first thing we have to understand isn't who is trading on the weekend, but rather who actually vanishes on Friday afternoon.
Yeah, the sheer volume of capital that just evaporates from the order books at the Friday close is staggering.
It's basically an exodus.
That's the perfect word for it. When we talk about the weekend exodus, we're talking about the withdrawal of institutional market makers. These are the massive proprietary trading firms, entities functioning like Jane Street or Jump Trading in the crypto space.
The whales.
The real whales. During the week, these firms are the ones providing the massive buy and sell walls. They are quoting both sides of the market constantly to capture the spread, and in doing so, they keep prices relatively stable.
So they're basically providing the shock absorbers for the market.
Exactly. They dampen the volatility.
I mean, we all know how order books work, but what's terrifying about the weekend is that the institutional bids at, say, the $60,000 support line, which have been sitting there like a concrete wall all week, they are literally deleted from the book on Friday at 5 p.m.
They're just gone. The depth doesn't just lower, it structurally vanishes.
And that's a critical distinction, right? They don't just stop trading.
Right. Their automated systems actively pull the resting limit orders.
Why do they do that? Just to avoid risk?
Precisely. These firms do not want to hold inventory risk over a weekend when traditional banking systems are closed. I mean, fiat on-ramps and off-ramps are bottlenecked. Major macroeconomic data feeds are silent.
So they're flying blind.
Yeah, exactly. If something catastrophic happens in the world on a Sunday morning, they can't easily rebalance their portfolios using traditional derivatives because, well, The CME futures might be closed.
Right, the traditional safety nets are down.
So they just pull their liquidity. It's the safest bet for them. And along with them, traditional banks are closed, meaning fresh institutional capital isn't flowing into crypto exchanges via wire transfers.
The pipes are dry.
Regulators are offline. And crucially, the traditional ETF flows, which have become this massive dictating driver for Bitcoin's spot price lately, those are completely paused.
So if all the heavy hitters pull their bids and asks, and the traditional capital pipes are frozen, who is actually left driving the bus on a Saturday afternoon?
You're left with a highly reactive cocktail. I mean, the market is basically handed over to retail traders.
Just everyday people.
Everyday people, yeah. Plus, crypto-native proprietary trading firms that specialize in thin markets and algorithmic decentralized exchange bots.
The DEX arbitrage bots.
Exactly. And highly leveraged speculators. So you're replacing this measured, algorithmically balanced institutional order flow with sentiment-driven, often deeply emotional retail flow.
Which is a dangerous mix.
Very. Especially when you mix it with predatory algorithms that are specifically designed to hunt that very emotion.
I look at this and it just makes me think of a casino.
Okay, I like that.
Like a casino where the floor managers and the high rollers have taken the elevator up to their penthouses for the night.
They're asleep?
Right, they're asleep. And they've left the blackjack and roulette tables completely open to the wild card locals.
Oh, that's bad.
You know, the rules of the game, like the matching engines of the exchanges, they are technically the exact same. But the vibe, the risk profile, the probability of someone just flipping a table, it's completely altered.
That is a highly accurate way to visualize it. I mean, in quantitative finance, we call this environment a liquidity vacuum.
A liquidity vacuum.
Right, because the major market makers have pulled their large orders from the order books. The density of bids and asks at every single price increment just thins out dramatically.
I want to pause on this concept of the liquidity vacuum, actually.
Yeah.
Because the math of it is where traders get completely destroyed.
Oh, absolutely.
If the depth dries up, it means the bid-ask spreads. You know, the gap between what a buyer is willing to pay and a seller is willing to accept, those widen out significantly.
They get huge. And more importantly, the price impact of a single market order is magnified exponentially.
Let's break that down for the listener.
Sure. So during a Tuesday afternoon, someone might execute a market sell order for, let's say, 500 Bitcoin.
A big order.
A very big order. But because the institutional order book is so thick, it only moves the spot price by a few basis points.
The market just absorbs the blow seamlessly.
Exactly. But on a Sunday morning, that exact same 500 Bitcoin sell order will slice through the thinned out order book like a hot knife through butter.
Wow.
Yeah, it might trigger a multi% price cascade because it has to travel much, much further down the order book to actually find enough buyers to fill the entire order.
Which means it takes significantly less volume to move the price.
That's the math.
That is a fundamentally dangerous environment. And there's another detail you pointed out in the sources that I found brilliant. The absence of the traditional news cycle.
Ah, yes, the fundamental catalyst void.
Right. We are so used to trading around catalysts, inflation reports, jobs data, Federal Reserve interest rate announcements, geopolitical press conferences.
All of that just halts over the weekend.
So what happens?
Well, this is a vital piece of the psychological puzzle. Think about the mindset of an active trader. When fundamental macroeconomic news disappears on a Saturday, those traders, they still have an urge to trade.
They're bored.
They're bored, and they still need a framework to make decisions. So what do they rely on when there are no earnings reports or Fed speeches?
The charts.
They rely entirely on technical indicators, support and resistance lines, moving averages, relative strength indexes, Fibonacci retracements.
Just drawing lines on a screen.
Basically, because fundamental catalysts are absent, technical analysis suddenly dominates price action to an extreme degree.
It becomes a massive self-fulfilling prophecy, doesn't it?
100%.
Because every single person left in this low liquidity market is looking at the exact same charts, drawing the exact same trend lines, and reacting to the exact same visual cues on their screen.
Precisely. If enough retail traders see a chart approaching a key moving average on a Sunday, they will all place their orders right around that line.
And there's no institution there to stop them.
Right. Without institutional flow to disrupt or counter that retail consensus, the technical lines hold or break purely based on crowd psychology. It is literally technical analysis in a vacuum chamber.
Man, that's fascinating. So If we've established that technicals and retail emotions are driving a send-out, low-liquidity order book, we really need to look at what the actual data says about how prices behave in this environment.
We need to look at the numbers.
Exactly, because there is a tremendous amount of mythology out there about weekend crypto trading.
Oh, tons.
Like, a lot of people just assume the weekend is pure, unadulterated chaos with massive 20% swings every single Saturday.
Right, the Wild West narrative.
Exactly. But our sources actually present a really nuanced, almost conflicting picture, which I want to dig into. Let's look at the Investopedia data first.
Okay, let's pull that up.
They ran an analysis on Bitcoin from 2022 to 2024. And their takeaway, surprisingly, is basically average daily price changes on weekends really aren't that drastically different from weekdays.
It's counterintuitive, isn't it?
It really is. They note that the total trading volume clearly forms a massive trough-like it drops off a cliff on Saturdays and Sundays. But the actual average price swing percentages aren't mind-blowing.
The Investopedia data is a great baseline. Looking strictly at their calculated averages for 2024, a Sunday showed a 1.21% average price change.
Okay.
And compare that to, say, a 0.11% average change on a Friday.
So Sunday is higher.
It is.
Yeah.
Statistically, that is a difference. Sunday is more volatile than Friday in that specific data set. But, I mean, a 1% move is not the wild double-digit swing that people associate with the early days of crypto.
Right, it's pretty tame.
Yeah, if you just look at those broad averages, you might conclude that the weekend is actually pretty boring.
But I have to push back on the Investopedia data here, or at least how people interpret those daily averages.
Because they smooth things out.
Exactly. An average can hide incredible intraday violence.
Oh, absolutely.
I mean, if Bitcoin drops 5% at 8 a.m., rallies 10% at noon, and then crashes 5% at dinner time, the daily open-to-close average change might look like zero.
Just a flat line.
Right. But anyone trading that day experienced absolute carnage.
And that is the danger of relying solely on daily closing averages in a 24-hour market. It completely smooths out the intraday whipsaws that actually liquidate traders.
Which brings us to the more advanced data.
Right. From Quantpedia and the Advances in Consumer Research Journal.
Because they looked past the simple daily averages, and they uncovered something they officially term the weekend effect.
Yes. And what is fascinating is that this effect is tied to a very specific structural evolution in the market, a date, actually.
October 2021.
Exactly. October 2021.
This is where the plot twists for me. What changed in October 2021 that broke the way Bitcoin trades?
October 2021 was the launch of the first Bitcoin futures exchange-traded funds, or ETFs, in the United States.
Okay, so Wall Street officially entered the chat.
Wall Street entered the chat, and Quantpedia's historical data shows that prior to this ETF launch, Bitcoin performed incredibly well during normal daily trading sessions.
It was just trending up normally.
It was truly a continuously trending asset. But the moment those ETFs launched, it tied Bitcoin's price discovery much more closely to traditional finance hours.
Because the institutional arbitrageurs got involved.
Precisely. And because of that, the intraday returns during the Monday through Friday work week essentially plateaued.
Wait, plateaued. Meaning, if you are a traditional day trader and you only hold Bitcoin from 9:03 a.m. to 4:00 p.m. Monday through Friday.
The data suggests you are missing out on almost all of the asset structural gains over the last few years.
That is insane.
The statistics bear that out. The real performance now accrues overnight and most dramatically from Friday's institutional close to Monday's traditional open.
The weekend effect.
The weekend effect. The ACR study proves this mathematically. They ran a comprehensive 7-day momentum strategy from January 2020 all the way to April 2025.
A huge sample size.
Very robust. For Bitcoin, the mean daily return on weekdays was 0.000012.
0.0012.
But on weekends, that mean return almost doubled. It jumped to 0.00023.
Almost double the average return just for the act of holding the asset over the weekend when the institutions are asleep.
Just for holding it.
And if you thought the Bitcoin data was interesting, the altcoin data is where this effect becomes truly weaponized.
Oh, the altcoins are a whole different beast.
The ACR study looked at Dogecoin, right, as a proxy for highly speculative retail assets.
Yes.
The weekday mean return for DOGE was 0.00021. The weekend return, 0.00052.
It's staggering.
That is a massive disproportionate amplification. I mean, why does a meme coin like DOGE explode on the weekend while Bitcoin just sees a moderate, albeit noticeable, bump?
Well, this ties perfectly back to the retail psychology and the liquidity vacuum we discussed earlier.
The casino.
The casino. Retail traders fundamentally are highly susceptible to cognitive biases.
Sure.
Two of the strongest biases are herding behavior, following the crowd, and overreaction to short-term momentum.
FOMO.
Pure FOMO. Now, altcoins, even in the best of times, have significantly lower liquidity than Bitcoin.
Right. They're thinner markets to begin with.
Exactly. So when you combine the weekend liquidity vacuum with a market now dominated completely by retail traders who are reacting emotionally to social media trends, TikTok videos, or Twitter momentum, you create a powder keg.
The guardrails are just gone.
Completely gone. When retail traders start piling into a Dogecoin trend on a Saturday afternoon because of a viral meme, there are no institutional sellers there to provide liquidity and temper the rally.
The adults are on the golf course.
Exactly. The market makers who would normally step in to short an overextended asset and bring it back to a fair value are on the golf course. So the momentum just builds and builds.
Unanchored from reality.
Completely unanchored from any fundamental valuation, purely driven by retail fear of missing out.
Okay, I am following the logic of the retail herding, but I have to stop you here and challenge this core premise for a second.
Sure, go ahead.
Because this still feels deeply counterintuitive to how we are taught markets actually work.
How so?
If the overall trading volume is lower on the weekend, which that Investopedia data absolutely confirmed, forming that deep volume trough on the charts, shouldn't the market inherently be boring? I mean, why does a lower volume of trading equate to sharper, more violent price swings? Shouldn't low volume just mean the price sits there doing nothing because nobody is trading?
It's an excellent question, and honestly, it addresses the single most common misconception about market mechanics.
Okay, clarify for me.
People constantly confuse volume with liquidity.
They aren't the same.
They are related, but they're absolutely not the same thing. Price impact.
Okay, I love a good analogy.
Think of the institutional order book during the week as a deep, Olympic-sized diving pool.
Huge. Deep water.
Right. There is a massive volume of water, which represents limit orders, just sitting there. Now, if you drop a massive boulder into that pool...
The boulder is a big buy or sell order.
Exactly. You drop the boulder and it makes a splash, sure, but the overall water level barely changes.
Right, because the sheer depth of the pool absorbs the impact.
The market absorbs the institutional flow seamlessly.
I'm with you.
Now, it's Saturday. The institutions pull their limit orders. The volume of water literally drains out of the pool.
So what's left?
Now you're looking at a shallow plastic kiddie pool.
Oh, boy.
There's very little water left. If you drop that exact same boulder into the kiddie pool...
All the water violently sloshes out.
Yes. The kiddie pool cannot absorb the impact. In market terms, the price impact of every single trade is magnified.
Oh, I see.
So even though there are fewer boulders being dropped overall, which is your lower total trading volume, the boulders that do drop cause violent systemic ripples.
That makes so much sense.
That is why a lower volume environment, when paired with a drained order book, leads directly to sharper, more erratic price swings. The market loses its ability to dampen shocks.
That is a brilliant clarification.
Right.
Okay, so we have this extremely shallow kiddie pool filled entirely with retail traders acting on self-fulfilling technical indicators, and sudden boulders dropping in from leveraged speculators or algorithmic bots.
That is a recipe for absolute chaos.
Which is exactly why we need to transition from the theory of the weekend effect to what this actually looks like on a trader screen in real time.
Application is key.
Right. I want to walk you through an audio chart right now. We are going to paint a mental picture using the specific tactical setups from IG Bank, Investopedia, and the quantitative models from Quantpedia.
This is a crucial exercise because knowing the structural theory of the liquidity vacuum is one thing. Recognizing the traps and opportunities on a live chart is a completely different skill set.
Completely different. So I want you to visualize this.
Okay, I'm visualizing.
You pull up a 1-minute candlestick chart using the Investopedia data. It is Saturday, August 24th, 2024.
A Saturday morning.
You are sitting at your desk, drinking your morning coffee. The market actually looks incredibly healthy.
Everything looks green.
Yeah. At 7:58 a.m., Bitcoin is getting pretty at $64,366. It looks fundamentally strong. You see a series of green candles marching upward, breaking through a key technical resistance line.
A textbook breakout.
Exactly. You think to yourself, here we go. This is the classic weekend breakout. Yeah. Retail is pushing it higher. So you enter a long position.
You take the bait.
You take the bait. But then, just 3 minutes later, at exactly 8:01 a.m.
Boom.
Boom. A massive, catastrophic red candle prints on the screen. The price violently plunges to $64,296.
Instant devastation.
In a matter of 180 seconds, the entire breakout is completely invalidated, and you are deeply, deeply underwater. What just happened to our hypothetical trader?
They just became the victim of a classic engineered weekend trap.
An engineered trap.
Yeah. In trading parlance, we call this a whipsaw or a fake-out. But the mechanics behind it are highly intentional. Remember the kiddie pool.
Yeah.
What likely happened in those 3 minutes is that a whale, a trader or an algorithmic bot with a significantly large amount of capital, saw the exact same chart you did.
They saw the green candles.
They saw the green candles. And the whale knows that all those retail traders are getting excited about the breakout. Furthermore, the whale knows exactly where those retail traders are placing their risk management orders.
Their stop losses.
Exactly.
Yeah.
They know that the crowd has placed their stop-loss orders just below the breakout point to protect their downside.
So the whale intentionally drops a boulder.
Exactly, but it's a calculated boulder. Because the liquidity is so incredibly thin on a Saturday morning, the whale knows they don't need $50 million to move the price.
They might only need $5 million.
Right, so the whale executes a sudden, aggressive market sell order. Because there are no institutional buy walls to absorb it, this sell order forcefully pushes the spot price down.
And what happens when the price hits that cluster of retail stop-loss orders?
Well, the stop losses trigger.
And a triggered stop-loss automatically becomes a market sell order.
Precisely. It creates a cascading domino effect.
How?
The whale's initial push triggers the retail stops, which dumps more sell orders onto the thin book, which pushes the price down further, triggering even more stops.
It's an avalanche.
It is an engineered cascade. The retail traders are stopped out of their positions at a loss. And then once the cascade finishes, guess what happens?
The whale buys it back.
The whale steps in at the bottom of the wick and scoops up the artificially cheap Bitcoin.
That is infuriating.
The price often reverses right back up to where it was 5 minutes ago, leaving the retail traders empty-handed and confused. This liquidity hunting happens constantly on weekends.
That is just brutal. It is literally predatory hunting. You are swimming in a shallow pool with sharks who can see exactly where you are hiding.
You really are.
So the obvious question is, how do you avoid being the prey? Let's walk through a step-by-step setup to actually trade this highly manipulative environment safely using the specific tools our sources provided.
Let's do it.
Okay, step 1. Identify the environment. IG Bank suggests that before you even think about placing a trade on a Saturday, you need to pull up your chart and apply the RSI.
The relative strength index.
Right. Explain how that works on a weekend.
So the RSI is a standard momentum oscillator, but its utility changes on the weekend. It basically measures the speed and magnitude of recent price changes to evaluate overvalued or undervalued conditions. It plots on a scale from 0 to 100. Traditionally, if the RSI is over 70, the asset is considered overbought and might pull back. If it's under 30, it is considered oversold and might bounce.
That's standard textbook stuff.
Standard. But on a weekend, the RSI is incredibly useful for identifying the broader regime.
What do you mean by regime?
I mean, is the market just aimlessly chopping sideways in a tight, illiquid range? Or is it actually building sustained momentum for a real structural move?
Wait, hold on. I have to challenge the premise of using the RSI here.
Okay, hit me.
If we just establish that the weekend market is a shallow kiddie pool where a single whale can spoof a price movement and trigger a cascade of fake volume, isn't an indicator like the RSI completely useless?
That's a fair point.
I mean, isn't it just measuring fake manipulated momentum? If a whale drops a boulder, the RSI is going to spike to 80. Why should I trust that signal?
That is a phenomenal counterpoint, and honestly, it is exactly why amateur traders get chopped up.
Because they trust the spike.
Yes. You are right. On a weekend, a sudden spike in the RSI on a short time frame, like a 1 minute or 5 minute chart, is often completely meaningless noise. It is just the splash from the boulder.
So how do you actually use it?
Where the RSI becomes valuable on a weekend is on the longer time frames.
Like the 4-hour.
The 4-hour or the daily chart, exactly. You use the macro RSI to define the boundaries of the weekend range, not to chase the micro breakouts.
Okay.
If the 4-hour RSI hits 75 on a Sunday afternoon and volume is thin, you don't buy the breakout.
You do the opposite.
You actively fade it. You assume it is an overextension in a low liquidity environment that will inevitably revert to the mean. You use the indicator contrarian to how you might use it on a high volume Tuesday.
Okay, that makes a lot of sense. You are using the RSI to find the edges of the kiddie pool, not to surf the ripples in the middle.
Exactly.
All right, step 2. Find your specific support and resistance levels. To do this, IG Bank suggests overlaying your moving averages. You are looking for the interactions, the crosses.
Yes, specifically the interaction between a short-term moving average, perhaps the 50 period, and a long-term one, like the 200 period.
The famous crosses.
Right. If you see the short-term average cross above the long-term average, that is universally known as a golden cross.
Which is bullish.
Very bullish. In a thin weekend market that is heavily driven by retail technical analysis, a golden cross can become a very strong, self-fulfilling buy signal.
Because everyone is staring at it.
Because fundamental news is dead. Everyone is staring at those two lines. When they cross, algorithmic bots and retail traders pile in simultaneously.
And the opposite is true as well.
Conversely, a death cross, when the short-term crosses below the long-term, acts as massive psychological resistance or a cascading sell signal.
All right, so we have defined our macro environment using the longer time frame RSI, and we have established our battlefield lines using the moving average crosses.
We have the setup.
Step 3, entry and exit timing. This is where we bring in the heavy quantitative guns. Yes. Quantpedia outlines a strategy they call the MX10 strategy. And I love dissecting this because it mathematically exploits the exact weekend effect we talked about earlier.
It's a great model.
Here is how it works. You pull up the daily chart right before the traditional equity markets close on Friday, say 3:55 p.m. Eastern Time.
Right before the bell.
You look back over the closing prices of the last 10 days. If Bitcoin is currently sitting at or very near a local 10-day high at that exact moment, that is your empirical entry signal.
It is a pure, systematic momentum play designed to completely strip away the emotional guesswork.
What's the logic behind it?
The underlying quantitative logic is brilliant. If Bitcoin has demonstrated enough relative strength and sustained buying pressure to hit a 10-day high right at the exact moment the traditional institutional players are wrapping up their week.
It means the big money is bullish.
Exactly. It implies that the institutional flow going into the weekend is fundamentally bullish. And because they are leaving, there will be no institutional sell walls to cap the retail momentum on Saturday and Sunday.
The momentum just carries through the vacuum.
Highly likely to carry through, yes.
Let's dig into the math on that look-back period, though. Why exactly 10 days? I mean, why not a 5-day look-back or a standard 30-day monthly look-back?
The 10-day window in the Quantpedia study represents a mathematical sweet spot for crypto assets.
A sweet spot.
Right. A 5-day look-back is too noisy. It just captures the random variance of a single work week. It's not a real trend.
And 30 days?
A 30-day look-back is too sluggish. In the crypto markets, a 30-day trend is practically ancient history.
That's true. Crypto moves fast.
So the 10-day window is roughly 2 trading weeks. It is long enough to establish a genuine, statistically significant structural trend, but short enough to be immediately actionable before the momentum decays.
Okay, so the mechanics of the trade are, you go long on Friday afternoon just before the 4 p.m. bell.
You buy in.
You hold your breath. You completely ignore all the 1-minute chart whipsaws and whale games we talked about on Saturday.
Do not look at the 1-minute chart.
And you target Monday morning, specifically when the traditional exchanges reopen and the institutional volume floods back in, as your automated exit point.
Exactly.
That trade systematically captures the overnight and weekend premium that the ACR study identified.
And if you are running a strategy like this, or even if you are just monitoring your portfolio, Binance Square's data highlights a really important point.
What's that?
You cannot treat the entire 48-hour weekend as one uniform block of time.
Oh, right. The timing windows.
Yes. There are highly specific time windows driven by global geography where the volatility profile radically shifts.
The high volatility windows, first, obviously, is that Friday evening to Monday morning stretch as a macro block.
Right.
But inside that block, Binance Square identifies the European-American overlap. That is 1300 to 16.00 UTC.
Yes.
Why is that specific 3-hour window so volatile on a weekend? I mean, theoretically, nobody in London or New York is at the office on a Sunday afternoon.
Because trading has become entirely democratized via mobile apps and global access?
Everyone trades from their couch now.
Exactly. Even though the traditional exchanges in London and Wall Street are closed, you still have massive residual global participation from retail and independent prop traders.
So it's just when everyone happens to be awake.
That 13.00 to 16.00 UTC overlap window is the period when traders in both the European time zones and the North and South American time zones are simultaneously awake, caffeinated, and active at their computers.
That makes sense.
Binance Square's on-chain data notes that historically, this overlap window sees 30 to 40% higher transaction volumes compared to the rest of the weekend.
It is the busiest part of the kiddie pool.
The water is really sloshing around then.
And the other critical window to watch is the late night hours, specifically 22.00 to 02.00 UTC. That is when the Asian markets, Tokyo, Seoul, Hong Kong, are waking up and starting their Monday morning while the West is still deep in its Sunday night.
That window is notoriously dangerous.
Why?
The Asian session wakes up and immediately reacts to whatever technical structures or news events developed in the West over the weekend.
They're playing catch-up.
Yes. And because the Asian markets are highly active in the crypto space, breaking news or sudden momentum shifts originating from Asia during those hours can trigger massive, liquidation-inducing volatility spikes.
Now we're all sleeping.
While the majority of U.S. and European traders are literally asleep and unable to manage their positions.
Which perfectly transitions us into the most terrifying part of this deep dive.
Oh, yes. The black swans.
Because you can be a quantitative genius. You can have the perfect daily RSI regime defined. You can have the perfect golden cross confirmed. You can be executing the max 10 momentum strategy flawlessly.
You can do everything right.
And absolutely none of it matters if a black swan lands in the kiddie pool.
None of it.
Yes. Let's talk about the existential threats. Macro gaps, whales, and real-world black swans. Menthor Q highlights this as the ultimate risk for anyone participating in the weekend market.
It's the ultimate risk because it's unpredictable.
We touched on leverage washouts, with the whale hunting the stop losses on the 1-minute chart. That is micro manipulation. But let's talk about when the macro structure truly spirals out of control.
Let's look at real history.
Real, terrifying Bitcoin history. Let's talk about Terra Luna, May 2022.
The collapse of the Terra Luna ecosystem is perhaps the ultimate textbook case study in why the weekend liquidity vacuum is so profoundly dangerous.
Set the stage for us. What was Terra Luna?
To understand the collapse, you have to understand the mechanism. Terra USD, or UST, was an algorithmic stablecoin.
Algorithmic, not backed by real dollars.
Correct. Unlike USDC or Tether, which supposedly have actual dollars in a bank backing them, UST maintained its $1 peg through a complex arbitrage algorithm linked to a sister token called LUNA.
Okay.
If UST dropped below $1, traders could burn it for $1 worth of LUNA, reducing the UST supply and theoretically restoring the peg.
So it was a machine designed to constantly balance itself.
Exactly. It was an arbitrage engine. But the machine relied on one crucial assumption: deep, continuous, frictionless liquidity to process that arbitrage.
And when did the attack happen?
When the initial attack on the USD peg happened, it started late on a Friday and accelerated straight into the weekend.
And that timing was not an accident, was it?
Not at all. The attackers knew exactly what they were doing. It was a highly sophisticated exploitation of the weekend market structure.
So what happened on Saturday?
When the peg started to slip on Saturday, panic ensued. The algorithm functioned as designed. It started hyperminting millions, then billions, of LNA tokens to absorb the selling pressure on UST.
Printing money out of thin air.
Yes, but because it was the weekend, the institutional market makers, the massive arbitrage desks, the deep pools of capital that could have absorbed that newly minted LNA supply.
They were offline.
They were offline.
There were no circuit breakers.
None. Zero.
In the traditional stock market, if the S&P 500 drops 7%, trading is automatically halted across all exchanges for 15 minutes to let people calm down and reassess.
Right, they pull the plug.
If it drops 20%, the entire market forcibly closes for the day. But crypto has absolutely no global circuit breakers.
And because the Terra collapse happened over the weekend, the institutional capital that might have stepped in to buy the dip, provide liquidity, and stabilize the system was largely sitting on the sidelines.
They couldn't intervene even if they wanted to.
Exactly. So the panic fed on itself. The algorithm hyperinflated the supply into an empty order book, and a $40 billion ecosystem went to zero in a matter of days.
$40 billion.
Gone. The lack of weekend liquidity was the accelerant that turned a crisis into an extinction-level event.
It was a completely unchecked freefall. And the terrifying thing is, a black swan doesn't even have to be a complex systemic algorithmic collapse, does it?
No, it doesn't.
It can literally just be a man with a smartphone sending a tweet. Think back to the bull run of 2021.
Elon Musk.
Elon Musk was obsessively tweeting about Bitcoin and Dogecoin. And a disproportionate amount of those market-moving tweets happened late on Saturday nights or Sunday mornings.
Right, because global news flow, social media virality, and billionaire impulses do not follow a Monday to Friday 9 to 5 schedule.
They just tweet when they want to.
Exactly. When a massive, unexpected sentiment catalyst, like the CEO of Tesla implying they might sell their Bitcoin treasury, hits the market during a period of profoundly low weekend liquidity, the price reaction is violently unanchored.
Because there's no one there to catch the falling knife.
Right. During the week, if Elon Musk tweets, institutional algorithms quickly assess the fundamental impact, provide liquidity, and dampen the swing.
They stabilize it.
But on a Sunday at 2 a.m., there is no institutional counterweight to say, okay, let's value this rationally. The retail market just runs with the emotion, and the thin order book allows the price to gap wildly.
Wow. But the black swan example that really stuck with me from our source material is the Silicon Valley Bank, or SVB, collapse in March of 2023.
Oh, the SVB weekend.
Because this perfectly illustrates the violent collision between the 247 weekend crypto market and the rigidly scheduled traditional banking system.
The SVB weekend is a masterclass in cross-market contagion. Let's walk through the timeline of that.
Please do.
Late in the week, on Thursday and Friday, news breaks that Silicon Valley Bank, a major pillar of the tech and crypto startup world, is facing a historic bank run and is in deep insolvency trouble.
Absolute panic in the tech world.
Yes. The traditional equity markets close on Friday afternoon in a state of absolute paralyzed anxiety. Nobody knows how deep the contagion goes. Over the weekend, the traditional markets are frozen. You cannot trade bank stocks.
You just have to sit and wait. But the crypto markets are wide open.
Exactly. And the crypto markets become the only real-time barometer for global financial panic.
That's a crazy concept.
It is. Over Saturday and Sunday, crypto traders are aggressively pricing in the potential systemic contagion. USDC, a major stablecoin with exposure to SVB, starts losing its dollar peg.
I remember that. People were terrified.
Bitcoin is wildly volatile. The weekend market is pricing in a catastrophic Monday morning for the global financial system.
Everyone is bracing for an absolute bloodbath at the Monday opening bell.
But then, late on Sunday evening, the Federal Reserve, the Treasury Department, and the FDIC step in and release a joint statement.
Very loud.
They announce they are invoking a systemic risk exception and will guarantee all deposits at SVB.
Boom. The rescue package.
Instantly, the systemic risk is taken completely off the table. The crypto markets, being the only open venue, react immediately and violently.
The surge, right?
Bitcoin and Ethereum gap up massively on Sunday night as the fear evaporates and traders rush to re-enter positions they panic sold on Saturday.
And this is where I need you to explain a very specific mechanism, because this creates a really weird, dangerous dynamic for traditional finance investors.
The dislocation.
Yes. Let's say I'm not a crypto native. I don't have an account on Binance or Coinbase. I don't trade spot Bitcoin on Sundays. Let's say I just hold a traditional Bitcoin exchange traded fund like the BITO futures ETF in my standard Vanguard or Fidelity brokerage account.
A very common scenario.
I physically cannot trade on Sunday night. So what mechanically happens to me when spot Bitcoin spikes 15% on a Sunday evening, but my brokerage app is locked until Monday?
This phenomenon is what the Mentor Q research refers to as cross-asset dislocation. And it is perhaps the most underappreciated risk factor for traditional investors dipping their toes into crypto assets.
How does it work?
If you are holding an ETF like BTO, your asset, the shares of the ETF, is tethered to the operating hours of the New York Stock Exchange.
940 to 4.0.
Right. But the underlying value of that ETF, the Bitcoin futures, is heavily influenced by a 247 spot market that never sleeps.
So they are out of sync.
Completely. So if spot Bitcoin rallies 15% over the weekend due to the Fed announcement, your ETF shares sitting in your account do not move a single cent.
Right. The price displayed on my screen is just frozen at Friday's 4.00 p.m. closing price. It looked like nothing happened.
But the moment the pre-market auction begins on Monday morning, the mechanics of the ETF structure kick in.
What happens?
The authorized participants, the institutional market makers who create and redeem shares of the ETF to ensure its price matches the underlying asset, have to instantly reconcile the massive discrepancy.
I have to close the gap.
Yes. The ETF's net asset value, or NAV, has functionally surged over the weekend, but the share price hasn't. So when the opening bell finally rings at 9:30 a.m. on Monday, your ETF has to catch up to the reality of the 247 market.
Violently.
Very violently. It will gap up at the open. The very first trade on Monday morning will be significantly higher than the last trade on Friday afternoon.
There's no continuous chart.
There is just a blank space, a gap where the price jumped overnight.
And the terrifying part is that gap can go the other way, too.
Absolutely. Think back to the Terra Luna weekend.
Oh, man.
If a catastrophic crypto crash happens on a Saturday, you are trapped in your traditional ETF all weekend.
Just helpless.
You are watching the underlying spot market burn to the ground on Twitter, but your brokerage app is locked. You are completely paralyzed, unable to sell and protect your capital.
And then Monday comes.
When Monday morning finally arrives, the authorized participants adjust the price and the ETF will gap down, opening at a massive immediate loss.
You suffer the entire weekend's drawdown in a single millisecond at the open.
Yes. This is why deeply understanding weekend crypto market mechanics is vital, even if you exclusively trade traditional finance ETFs within a 401k. The 247 tail is violently wagging the 9-to-5 dog.
Wow. Okay, so what does this all mean for you, the listener? How do we actually survive this architecture?
We need rules.
Because we have painted a fairly grim picture of a market filled with stop-loss hunting whales, missing institutional guardrails, drained kiddie pools, and violent Monday morning gaps that completely bypass your ability to react.
It sounds scary.
It does. And I don't want to just scare everyone. I want to provide a concrete survival guide. So let's transition to the practical application. MentorQ and IG Bank have laid out some very specific, actionable risk management rules and psychological frameworks so you don't get wrecked.
The rules of engagement have to change on the weekend. The first and most critical rule of weekend risk management, according to MentorQ, is a mechanical adjustment of your position sizing.
Meaning, quite simply, trading smaller.
Yes, but the math behind why you trade smaller is really important.
Walk us through it.
Because the bid-ask spreads are structurally wider, and the price impact of every order is magnified by the liquidity vacuum we talked about, a 1 or 2% price whip can happen in the blink of an eye.
Just instant volatility.
Right. So if you normally trade with, say, $10,000 positions on a highly liquid Wednesday, you need to scale that back.
How?
Perhaps to a $5,000 or even $3,000 position on a Sunday. Trading smaller mathematically accounts for the increased slippage you will inevitably face when trying to enter and exit trades in a thin order book.
It gives you a buffer.
It ensures that a sudden weekend volatility spike doesn't trigger a catastrophic margin call.
And what about stop losses? Because we just spent 10 minutes talking about how algorithmic whales will intentionally spoof the market to trigger those exact stop loss orders and steal your liquidity.
Right.
If the whales are hunting stops, do you just fly blind and not use them?
It is a highly debated topic among professional traders. MentorQ suggests a compromise, using significantly wider stop losses on the weekends compared to your weekday strategy.
Okay, what does that look like?
If your standard weekday stop loss is tightly coiled at 2% below your entry price, maybe your weekend stop loss needs to be loosened to 5 or 6% below your entry.
You essentially have to accept a wider margin of error to survive the noise.
Exactly. You have to give the asset enough mechanical room to breathe through the random low-volume whipsaws without prematurely kicking you out of a fundamentally sound position.
That makes sense.
Now, some highly advanced screen-glued traders prefer manual management.
Manual management.
Yeah. They refuse to put an automated hard stop loss into the exchange's order book, specifically to avoid broadcasting their location to the hunting algorithm.
They're hiding.
Exactly. Instead, they sit at the screen, monitor the macro RSI and the moving averages, and manually execute a market sell order only if the actual structural trend of the asset breaks.
Rather than getting knocked out by a 3-minute fake-out wick.
Precisely.
That sounds completely exhausting.
It is.
I mean, that requires iron discipline, zero emotional attachment, and an unhealthy amount of caffeine. I cannot imagine manually staring down a collapsing chart and having the discipline to hit the sell button at the exact right moment of invalidation.
It is incredibly difficult, which is why manual stops are generally not recommended for anyone other than full-time professionals.
Fair enough.
But there is another mechanical metric. MentorQ suggests watching to gauge the hidden danger in the market. Perpetual futures funding rates.
Oh, this gets a little technical, but I know it's important.
It is one of the most powerful predictive tools for weekend volatility.
Let's break down the funding rate mechanism, because I know a lot of spot traders completely ignore the derivatives market, and that is a massive blind spot.
It is a huge blind spot. So perpetual futures contracts do not have an expiration date.
Right.
To keep the price of the futures contract tethered closely to the actual spot price of Bitcoin, exchanges use a mechanism called the funding rate.
How does it balance it?
Essentially, it is a fee exchange between the traders who are long betting the price will go up and the traders who are short betting it will go down.
Okay.
Think of the funding rate as a pure mathematical sentiment barometer. If the market is overwhelmingly bullish and everyone is using high leverage to go long, the futures price will drift higher than the spot price.
It gets out of whack.
Right. To balance the market, the exchange forces all those long traders to pay a fee, the positive funding rate, every 8 hours to the traders who are going short.
So you literally have to pay a penalty for being in the crowded trade.
Exactly. Now, apply this to the weekend. When you look at the data on a Saturday afternoon, the volume is dead, the order book is thin, but you see extreme, elevated positive funding rates.
What does that tell you?
That means the retail crowd is incredibly greedy and over-leveraged long, despite the lack of institutional support.
The kiddie pool is full of leveraged longs.
Yes. In a low liquidity environment, that extreme positive funding is a glaring warning siren. It signals that the market is top-heavy.
So it's fragile.
Very. It only takes one small boulder, one moderate sell order from a whale, to push the price down just enough to trigger a long liquidation.
And then the cascade happens.
That single liquidation forces a market sell, pushing the price down further, triggering the next liquidation. It is a cascading long squeeze.
So extreme positive funding on a weekend is a precursor to a violent downward correction, and vice versa.
Yes, extreme negative funding means everyone is excessively fearful and panic shorting the market, paying the longs to keep their positions open.
So the pendulum swings the other way.
Right. That excessive crowded bearishness in a thin market is often the perfect architectural setup for a sudden, violent short squeeze bounce.
The short squeeze.
The whales will buy just enough to trigger the short liquidations, sending the price rocketing upward. Watching those funding rates gives you a literal mathematical window into the crowd's leverage positioning, allowing you to anticipate the squeeze before it happens.
Okay, so we have the mechanics down. Position sizing, wider stops, monitoring funding rates to avoid the squeezes. But let's get deeply real for a second.
Let's do it.
The hardest part about weekend trading isn't calculating the funding rate math or drawing the Fibonacci lines.
No, it's not.
It is the raw internal psychology.
The mental game.
Because the reality of weekend trading is that you are sitting on your couch on a Sunday. The traditional stock market is closed. Your fantasy football team might be losing. And you are staring at a crypto chart that is moving at an agonizing, chopped-up snail's pace for 6 straight hours.
Just brutal chalk.
And then suddenly it flashes violently for 10 minutes, only to go dead again. The psychological toll of that environment is absolutely brutal.
It truly is. The weekend market is almost perfectly designed to exploit human impatience.
How so?
In these slow, choppy, low liquidity environments, traders routinely fall victim to 2 main psychological traps that destroy their portfolios.
The first one is FOMO, right?
The first is FOMO, fear of missing out. They have been staring at a flatline chart all day. Suddenly, a low-volume, meaningless spike occurs.
They see green.
Their brain registers action. They assume this is the start of the massive macro rally they have been waiting for, so they market buy right at the absolute top of the wick.
Coach?
Only to watch the price immediately retrace minutes later as the whale takes profit.
The classic whipsaw we talked about.
But the second trap is even more insidious, and it is what behavioral economists call the boredom trade.
Oh, I am intimately familiar with the boredom trade.
Everyone is.
Explain it for the listener, just in case they're lucky enough to not know.
You are staring at the screen for hours. Your perfectly designed quantitative setup hasn't triggered.
Nothing's happening.
The RSI isn't at the extremes. The moving averages are just tangled together, not crossing. There is no edge.
But you want to press a button.
Exactly. You are a trader and you feel a psychological compulsion to do something. You want the dopamine hit of being in a position.
So you invent a reason.
You invent a pattern that doesn't exist. You take a low probability entry that completely violates your established system simply because you are bored.
That's so dangerous.
In a thin, manipulative market, boredom trading is a fast track to bleeding out your account through 1,000 tiny, poorly planned cuts.
So what's the solution?
Patience. The ability to sit on your hands and do absolutely nothing is the ultimate weekend strategy. If the high probability setup isn't there, you must walk away from the screen.
But what if active scalping, managing manual stops, and fighting the psychological urge to boredom trade all weekend is just fundamentally too stressful?
It is for a lot of people.
Right. What if you believe in the long-term thesis of crypto? You want the exposure, but you want to fiercely protect your mental health and actually enjoy your Sunday.
There is a way.
IG Bank outlines a brilliant, utterly boring alternative strategy. DCA, dollar cost averaging.
DCA is the ultimate structural antidote to the toxicity of weekend volatility psychology.
It just removes the human element.
It removes it entirely. Instead of trying to outsmart the whales, time the fakeouts, or parse the noise of a 1-minute RSI chart, you automate your behavior.
Set it and forget it.
You select a predetermined set amount of capital, say $100, and you program your exchange to buy Bitcoin at the exact same time on the exact same day every single week, regardless of the price.
Every Sunday at 2 p.m., rain or shine, whether the market is crashing or mooning.
Exactly. By implementing strict DCA, you completely bypass the emotional roller coaster. When the market flashes down because of a weekend liquidity hunt,
You're buying cheaper.
your $100 mechanically buys more fractions of Bitcoin at a cheaper price. When the market is squeezing upward in a euphoric FOMO rally, your $100 buys slightly less.
It smooths everything out.
Over a long enough time horizon, this mathematical smoothing process mitigates the intraday volatility and completely removes the psychological burden of having to stare at candlestick patterns on a Saturday night.
You just step out of the kiddie pool entirely.
You don't even get your feet wet.
It is incredibly liberating. And look, whether you are an active weekend scalper, meticulously running the Quant PD Max 10 momentum strategy to capture that Friday to Monday premium,
Or you're just DCAing.
or you were just a passive investor holding a traditional BTO ETF in your retirement account. Understanding these specific liquidity games, the order book dynamics, and the psychological traps is vital.
It's essential context.
It gives you the necessary context to not panic sell your portfolio on a Sunday afternoon just because an algorithmic whale dropped a boulder in the kiddie pool.
Exactly.
It gives you the framework to look at a terrifying red candle and say, okay, the volume is abnormally low, the bid-ask spread is temporarily wide, the institutional circuit breakers are offline. This violent price action is an anomaly, not the fundamental truth of the asset.
Context is everything in finance. The weekend crypto market is a unique, highly psychological, structurally distinct ecosystem.
It really is.
The low liquidity creates incredibly dangerous engineered traps, but as the rigorous data from the ACR study showed us, it also creates highly profitable momentum setups for those who understand the underlying math, know how to read the tape, and strictly manage their position sizing.
So it's not inherently bad.
It is not a market to fear blindly, but it is absolutely a market that demands profound respect.
I love that framing. Respect the weekend architecture. But as we wrap up this deep dive, I want to throw one last, much larger macro implication at you. Something for everyone listening to really mull over.
Please do. I'm ready.
If we connect all these specific crypto mechanics to the broader, overarching picture of where global finance is inevitably heading, Wall Street is pushing deeper and deeper into the digital asset space.
Unstoppable trend.
We now have spot Bitcoin ETFs, Ethereum ETFs, and highly complex options trading being approved on those ETFs.
The big money is here.
Traditional legacy institutions are finally getting a massive taste of an asset class, a settlement layer that literally never sleeps.
And they love the fees.
They do. So this raises a profound structural question for the future. Will the massive institutional demand for continuous 247 liquidity and continuous price discovery eventually force the traditional legacy stock exchanges, the New York Stock Exchange, the NASDAQ, to abandon their archaic 9-to-5 schedules and simply never close?
Oh, that is a massive question.
Imagine a world where you are trading Apple stock or hedging a Tesla position at 3 a.m. on a Sunday morning because breaking supply chain news just hit out of Shanghai.
It would completely change the world. And the technology to do so obviously exists. Crypto has proven that a 247 global matching engine works flawlessly.
Right.
And if traditional equity and commodity markets do eventually capitulate and move to a continuous 247 model to match the pace of crypto,
What happens to our weekend?
Will the weekend effect we just spent an hour dissecting cease to exist entirely? If the massive institutional market makers are forced to provide liquidity all weekend long across all asset classes, the kiddie pool fills back up with water.
The vacuum is gone.
The liquidity vacuum is eradicated, and the structural anomaly we exploit today might just disappear into the history books.
That is wild to think about. The massive weekend volatility, the DOGE coin weekend pumps, the Sunday night ETF gaps, they might just be a temporary historical glitch.
A growing pain.
Exactly, a growing pain, while the legacy financial system slowly catches up to the reality of the internet.
It's very possible.
We really want to hear from you on this. Do you actively trade Bitcoin or altcoins on the weekends? And what kind of tangible results are you getting in this low liquidity environment?
Are you surviving the kiddie pool?
Right. Are you successfully catching the momentum wave of the weekend effect using strategies like Max 10? Or are you getting caught and chopped up in the stop-loss whale traps?
It requires a highly specific, almost contrarian discipline. I would be genuinely fascinated to hear how people are managing the internal psychological side of it, specifically how they resist the urge of the boredom trade.
Absolutely. Reach out and let us know your battle stories. Thank you so much for joining us on this deep dive into the mechanics of the market.
It's been a blast.
The next time you pull up a crypto chart on a Saturday morning, just remember, the institutional adults have left the room, the streetlights are on, the order books are paper thin, and you're playing in a very, very different city. Stay sharp out there.